Hello, welcome to our session today with LGFP Enhancing Financial Reporting Maturity. I'd like to acknowledge the traditional owners of the land on which we meet today. For me, here in Clermont, that's the Wangan and Jangalingu people, and pay respect to their elders past, present and emerging. I'd like to extend the acknowledgement to the traditional owners of the land, wherever you may be joining us from today. So today we have Enhancing Financial Reporting Maturity presented by Crowe, and we have Tracy Mayhew and John Zabala with us. So Tracy has 12 years experience, professional with a diverse expertise, including external and internal audit services and lots and lots and lots and lots and lots and lots of other stuff. And John would be well known to many of us from his work with our audit and risk committees. He's a senior partner with the Audit and Assurance Division and based in Brisbane. The session will explore improvement opportunities that will relieve the year-end financial reporting burden and facilitate early certification of financial statements. So we're going to look at enhancing your month-end processes, establishing year-end financial reporting plans, and enhancing our asset management and asset valuation processes. The session will be followed by a Q&A opportunity. So to submit questions throughout the live session, please use the live Q&A button on the bottom toolbar of your screen, and you can send those through at any time. I'll hand you over to Tracy and John, and have a wonderful webinar. I'll see you for the Q&A.
Good morning all. Thank you very much for everyone joining in this session. I'm really excited that you'll be getting a lot of insight from Tracy. Tracy's going to do the majority of the presenting today. As outlined in the brief introduction there, Tracy has a wealth of experience in working with local governments right across Queensland, from the very south all the way to the very tip. And over the previous years, Tracy has really gathered a lot of insight around how financial reporting maturity within councils can not only be improved, but can actually be brought up to a very high level. And given the focus that is placed on financial reporting maturity within the Queensland Audit Office and those that pesky end of financial year process, I'm sure you're going to find some great tips and insights from Tracy during this presentation. So, Tracy, I'll hand over to you.
Thanks, John, for the introduction, and thank you to the LGFP committee for inviting us to present today on the topic of financial reporting maturity. As John mentioned, at Crowe, we have a really diverse range of experience within the local government sector right across Australia. And this experience has given us insights into the many and often competing priorities that finance professionals in these organisations face. And add to that the difficulties in attracting and retaining skilled staff, and it becomes an even greater challenge. So we appreciate that there's a lot of work that goes on behind the scenes all throughout the year. Unfortunately, we haven't found a silver bullet solution, so apologies if that's why you registered today, but hopefully we're able to share some tips or some timely reminders that will help ease the challenge somewhat and enhance your council's reporting quality and timeliness. Summarised on this slide are just a small number of reasons why month-end and year-end processes are so important. They help manage key person risks by establishing a documented set of tasks, responsibilities and timeframes, which can be referred to in the event of sudden turnover of key staff. They reduce the burden on existing resources by identifying and planning for resource gaps. They support a smooth audit process and timely sign-off, and improve the quality and timeliness of financial reporting, enabling users of financial statements to make more informed decisions. I wanted to start by talking about month-end processes. And when we talk about mature month-end processes, it can be grouped into the following categories. And you may be familiar with these from the QAO Financial Reporting Maturity Self-Assessment, which was released a couple of years ago. If you haven't seen this resource, or maybe it's been a while since you last dug it out, I would encourage you to do so because it's a really useful tool to assess where your council sits in the spectrum of maturity and highlights areas of focus to enhance maturity. Keep in mind, though, that not all councils will sit at a 4-star rating, and nor should they, because that just wouldn't be cost effective in all instances. But it's about finding the right balance to fit your council's needs. So to explore these areas a little further, month-end processes refers to the processes to close out the current month and prepare finance reports for councils. A quality month-end process should make 30 June feel like just another month-end. Early close areas are performed before balance date and therefore not required to be fully re-performed as part of the financial statement preparation process. They typically include areas such as asset valuations, major estimates and judgments, stock takes, and other material note areas. Financial statement preparation refers to the systems, processes, and resources in place to produce high quality and timely financial statements. So to put this into a little bit more context, a high level of maturity would mean that reconciliations are highly automated and reports are produced from the finance system at the click of a button, as opposed to information being extracted and manually manipulated and reconciled before being fed back into a reporting model. Again, keep in mind that each council will sit in a different range of this spectrum. And finally, financial reporting matters refers to how complex or contentious matters are dealt with in preparing the financial statements. On this slide, I've just included some examples of what we see as being strong month-end processes. Cash accounting or hybrid cash accounting is still something we see quite commonly in the sector. And this plays against month-end and year-end maturity in that the bulk of balance sheet reconciliations and adjustments are left till year-end. This impacts on the workload of staff at year-end, but also skews monthly financial reporting because revenue and expenditure are not being recorded as it's earned or incurred throughout the year. And it's important to note that users of financial information are essentially not being provided with complete or accurate financial information for their decision-making purposes because not all transactions and balances are being reflected throughout the year. And there's the potential for large variations between the June finance reports and the annual financial statements once they're prepared. So some tips from us are perform balance sheet reconciliations for all subsidiary modules. So think things like debtors, creditors, rates, payroll. Reconcile work in progress on a regular basis, adjust for contract balances, employee provisions, and clearing accounts and the like. Process depreciation, capitalizations, and disposals on a monthly basis and not just at year end. Perform quality checks over month-end reconciliations and financial reports and don't wait until year-end to resolve exceptions. It's far easier to resolve as you go than having to try and work back through 12 months worth of data to resolve an issue. Prepare reports on an accruals basis, include variance analysis, root cause commentary, and other financial and non-financial information that might be useful for users of that information. Undertake regular tracking and reporting of audit issues to ensure they're resolved on a timely basis. And ensure there are processes or other mechanisms in place to keep your data safe. Keeping in mind that each council will be different, here's a few questions that we wanted to pose to you, to hold up the mirror, so to speak, and understand where your council sits in that maturity scale. So are there procedures in place to support month-end reconciliations and reporting? Do you already have a year-end close checklist? And within this, have you identified opportunities to perform hard close procedures as part of month-end? How do you rate the timeliness and consistency of reporting within your organisation? Are there mechanisms to ensure timely identification, reporting and resolution of financial reporting or internal control matters? And just how secure is your data? And on that note, I might just flick back to John, who's going to provide some insights around cybersecurity and financial reporting.
Got to unmute first. Sorry, thanks, Tracy. Look, I think there's something to be said around cybersecurity. There's been quite a lot of press in recent times in relation to access to sensitive data and how it's being distributed out there in the real world, and for want of a better word, then holding entities to ransom to not distribute that data. So one of the areas that we have seen in terms of financial reporting is, Tracy did mention, around extracting information from your secure data sources in order to manipulate or to transpose that information to be able to present reports, whether it's to your councils at council meetings, or whether it's to for other required reporting contents to committees and subcommittees. As a result of that, one of the areas that we have identified in other instances is that that information, once it's extracted, is on a lot of occasions not secured. So it is being held in relatively open file sharing areas. And the potential is that whilst there may be an intrusion or a hack, they may not be able to get access into your quite secure cloud-based servers or even remote type infrastructure. But because you do have users who have extracted that information internally, they've then saved the extracted data into possibly just a flat file, whether it's Excel, text, and they are then saving that into probably quite nicely worded folders, something like, data from rate system, that this then provides an opportunity for someone who has intruded into the system to actually extract that information without having to get into the secure database areas. So one of the things that we are really looking to improve in terms of the maturity around financial reporting is how you actually are able to, rather than extract information and then manipulate it using tools such as Excel, is to really start to look at how that can be a little bit more integrated. So whether the system that you're using has that facility to write those standard reports or tailored reports, or alternatively using more secure manipulation sites such as data lakes or data warehouses, where the information is then able to be accessed through, once more, direct reporting software such as Power BI or the like. So I think that's just in terms of assessing that maturity level, really do have a good look at how information is being extracted, manipulated, and then represented. Thanks, Tracy.
Excellent. Thanks, John. Thanks for sharing that. These slides will be made available after the session as well. So as I said, we do encourage you to take these questions back, reflect on them yourself, and obviously pose that to some of your team members as well, just to get a good gauge of where you sit on that maturity scale and where there could be some opportunities for enhancement. As I mentioned a little earlier, a quality month-end process should really make 30 June feel like just another month-end. But I don't want to take away from the fact that year-end and audit preparation also requires very detailed planning in order to manage the range of deliverables and internal and external stakeholders who are involved in the process. So our top tips, as we've summarised here on this slide: start planning for year-end early. You need to identify who needs to be involved, both internal and external to the organisation. Identify where experts may be required and engage them and set expectations with them early. So think, external valuers or other advisors that you may need to lock in. Lock in key meeting dates and deliverable dates well in advance, so audit committee dates and internal delivery and review dates, to make sure you've allowed sufficient time for all aspects of the year-end close process and financial statement preparation, that it's given the attention that it deserves, and you've got sufficient time for internal quality checks and approvals as well. This is supported by developing a detailed timeline, which includes who is responsible for doing what and when. And it's good practice to aim to bring forward, well, I'll put a challenge out there that it's good practice to aim to bring forward timelines incrementally each year to improve on your timeliness year on year. And trust me, it can be done. And in developing this timeline, it's best to be as granular or as specific as possible, in particular where there's information that may be required from other departments or information or coming from external parties to the organisation. It's best to plan this in advance so that you've got the information for when you need it and it doesn't cause unnecessary hold-ups. The next one is to prepare shell accounts and position papers nice and early. And again, this may require the use of experts, so make sure you've engaged with them and start this process early. It's best practice that shell accounts and position papers are reviewed and approved by the audit committee. So again, factor this into your plan so you've got sufficient time to prepare, distribute and have that review function. And as we've touched on a little bit already, identify those areas where there's the potential to perform hard close procedures to take this burden out of the year-end process. Again, just some suggestions here or some questions to take back and reflect on to gauge where your council sits on that maturity scale. Have you previously reflected on past experiences to identify what worked well, where were the roadblocks, and how this can inform your approach to this year end? How effective are internal processes in identifying errors prior to audit? For example, if material adjustments were identified as part of the audit process previously, does this highlight potential opportunities for improvement or areas that may have been overlooked previously? Has sufficient time and resources been allocated to the higher risk areas of your financial statements? And make sure that your plan prioritises these areas and seek resource support if needed. Who are the key stakeholders, and is everyone invested in your year-end plan? So this would include executive, councillors, audit committee, teams spanning finance, assets, governance, legal, as well as your external stakeholders like your valuers and auditors. And does your year-end plan cover all aspects of the financial statements? It's important to plan early to have timely, accurate and complete information for all disclosure areas, in particular information that's not generated directly from the trial balance. So think about those note areas such as contingencies and commitments, transactions with related parties and the like. They all form part of the statements and need to be prioritised as part of the year-end close process. Over the next few slides, we just wanted to step through some financial reporting matters that we see quite commonly in the sector. So these are the areas where the expectation is that councils would be providing a position paper to the auditors to support these areas. And it's not an exhaustive list. So throughout the year and as part of the year-end planning process, ensure that any unique or isolated issues are flagged internally with your audit and with your auditors, so there's no surprises during the process. I'm sure it's not new information that PP&E valuation considerations should not be underestimated. And this slide really puts into context the range of complex and subjective inputs into fair value models. And many, if not all of these inputs require the expertise of engineering and infrastructure staff or other experts. So again, just circling back as a reminder, to factor this into your year-end plan to make sure you're engaging with those team members. So for example, information supporting unit rates, asset conditions, useful life and remaining service potential are all informed by asset management plans and other data coming from these teams. And on the flip side to that, an effective and collaborative valuation process also helps to inform asset management plan, maintenance and renewals. So works hand in hand and again, just a reminder, that it is a team effort and to have those different perspectives. When we're talking about comprehensive revaluations and fitting this into the year-end plan, a comprehensive revaluation can be done at any time of the year, but goes without saying that it's best to be completed before year end. April is generally an ideal time or a common time that we see comprehensive valuations being finalised, which really means that the process should be commencing as early as November or December of the previous year to allow enough time to appoint valuers, set expectations and timeframes, and then to be able to review the data thoroughly prior to audit. It's important to, again, establish a project team and plan, know who your key stakeholders are, and make sure they're comfortable and aware of their responsibilities in the process. As we've touched on, this team should include finance and infrastructure team representatives to facilitate collaboration on those critical inputs. Councils also need to reconcile asset data before and after valuations have been completed to ensure the completeness and accuracy of the information that makes its way into the fixed asset register. And in the instance that unrecognised assets or found assets are identified as part of the valuation process, it's important to isolate how many and the value of these assets, understand why they were previously unrecognised, and determine the appropriate accounting treatment. And this is something to discuss nice and early with your auditors as well. Don't underestimate the desktop review process when it comes to valuations, as this still requires collaboration across a range of internal and external stakeholders. Oftentimes there can be a lag in the availability of cost index data. So where you've performed an interim assessment, it is important to revisit this once updated information becomes available post-balance date to make sure that your conclusions or proposed indexation remains appropriate. It can also be useful to benchmark against recent projects or other data to ensure indexed unit rates remain realistic. If your council is engaging an external expert, and this goes for comprehensive revaluations as well, councils still need to apply sufficient scrutiny over the completeness and accuracy of the results. It's not just a matter of passing the valuer's report or workbooks on to the auditor. Councils really need to take that step back and challenge the results that are coming through to ensure that they're accurate and realistic. A number of local government areas have been impacted by natural disasters this year or are still undertaking works from previous events. I will just put in a little plug to the guidance paper that was issued by the LGFP committee last year, as this is a really, really valuable resource in understanding the potential accounting and financial reporting considerations when dealing with flood damaged assets. Councils need to develop a position paper that sets out the extent and estimated value of damage, proposed revenue and expenditure recognition and classifications, the impacted balances and potential adjustments and disclosure requirements. Again, this is an area that will require collaboration and input between finance and infrastructure teams, so engaging early around this is critical. And the third area we see quite commonly is remediation provisions. Again, it's quite a complex area in terms of identifying where remediation obligations exist. So think environmental authority documents that overlay tips, quarries and gravel pits, as well as understanding the cost and timing of remediation obligations on councils. These estimates should be updated annually, incorporating updated net present value inputs. Councils should prepare a position paper on an annual basis, and on this slide here we've just highlighted some of the key information, as I've already talked through, that your auditors will require to be able to support, or to understand and support council's estimates. So that brings us to the end of what we wanted to cover as part of the presentation. And we've covered quite a range of things. So I guess just to reframe on the key messages, a strong month-end process equals better quality and more timely financial statements. So I'd encourage you to reflect on some of the questions that we posed earlier in the session, or utilise the QAO checklist as a means of assessing maturity and identifying areas for enhancement. If you haven't already, set a year-end reporting plan, engage with your key stakeholders, and have mechanisms or touch points to monitor progress. Be aware and plan early for significant financial reporting matters, understanding though that some things do just crop up along the way unexpectedly. But if you've got a well-set plan, that just helps to, work through those in a timely or a smooth manner without too much disruption to other aspects of the year-end close process. And finally, communication is key, and this includes internal and external stakeholders, as well as with your auditors. The audit process is intended to be collaborative and constructive and value-adding. So the earlier any potential issues are raised, the better the outcomes will be. John, was there anything that you wanted to add just to round out the presentation? I know you do have to drop off shortly.
Yes, I do have to jump off, but look, Tracy, a fantastic summary there. I think one of the things that really resonated for me during that was around some of the areas to be prepared for. Really, it highlights, I think, really risks that are going to come from your external auditors as well. So a lot of the delays, I think, in terms of that maturity and presentation of financial statements can really be alleviated by having those early conversations with your external auditors, whether it's the QAO or their contractors. Certainly they are communicating that information in their early client strategies. And if you have not taken the opportunity to invite them into meetings, whether it's with even just with your finance team and not necessarily organising it specifically with audit committees, I'd certainly also commend that as a really good opportunity to understand where some of those risk areas that certainly Tracy has identified are, I think, some of the more common and ones that have been coming up on a regular basis that we've seen across some of the councils, particularly I think in more regional type areas where there has been impact from flooding and the like. But look, please make sure that you are taking that really good opportunity to talk to your auditors. They are going to be outlining fairly actively at the early stage of their engagement with you around where some of those risk areas are and where you can really get some value in terms of being prepared with position papers and the like for that upcoming end of financial year process.
Excellent. Thank you, John. And now I think I will hand back to Zoe to moderate any questions which have come through the chat.
And Tracy, that was an amazingly informative presentation, particularly good for people who are new to local government or the year-end process. So I remember, God, 20 odd years ago coming into local government and going, what do we do? That was a great presentation, and anyone who is watching, I would encourage you, the recording will be available on YouTube afterwards, so I would encourage members of your team who missed out on our live webinar to go back and have a look and watch the presentation. So we have questions coming in. Remember, if you please have questions, if you have questions, enter them in the live Q&A box to submit and so that you can get an answer from Tracy. So we have a question here, Tracy. Do you have tips on assessing materiality? Auditors seem to want to see note disclosures for some items, for example, leases, even though they're not material for us. Good question.
It is a good question. So within your external audit plan that's issued by your auditors, there should be the materiality calculations and benchmarks in there. So that's probably the first point of call in understanding what the materiality thresholds are as a first point. I guess it is important to know that materiality considers both qualitative and quantitative factors. So even though a particular financial statement area may not be material in value, I guess it's just taking that step back to understand, is there information that is important to users of the financial statements that if it's not included or disclosed in such a way, could be misleading, in their decision-making capacity. So again, that's going to be a judgment call for each individual council and the particular financial statement area that may be in question. But yeah, I guess it's just taking that step back to understand whether there are some non-financial factors in play in terms of how that information is included or disclosed.
Okay. Oh, people, don't be shy. We haven't had any other questions come through yet. That must mean that everyone's on top of their end of financial year plan. We're a month. We've
all superstars.
Everyone's superstars, and no questions. Well, I guess it's. Oh, look, we have another question coming through. So, the pro forma statements not updated for the current year events and transactions is an issue in financial reporting. What would best practice look like to address this?
Yeah, I think when it comes to preparing your pro forma statements, obviously the guidance is released through the department with the tropical model to give updates on more so from an accounting standard and disclosure point of view. So that is just a guide. I guess as part of that process, do take the opportunity to update and tailor, look for opportunities to simplify the presentation of the financial statements as well, and flag early any new changes or events in the current year that may have a financial reporting implication. So yeah, I guess just to those comments that had been raised by QAO there, it's, don't just burn through prepping the pro forma statements as just another item on the tick list. Yeah, step back, identify where there could be some potential financial reporting or disclosure implications for current year events and transactions, and build that in as part of the pro forma preparation process. That also enables internally and the audit committee to have a review over that early, make sure everyone's in agreement with those disclosure items as well.
Yeah, I guess best practice in that instance from the audit office point of view would be for us all to do soft closes at the end of May and have shell statements that actually have current year data in them. So in a perfect world, I guess.
Yeah, even if it's just incrementally bringing some of those hard close activities in as well, that can be a big help in reducing that year-end burden, and yeah, having more informative pro forma statements as well.
So when you did talk about the hard close activities, I guess, what in your experience have you seen councils, particularly, I guess, the regional and the smaller councils, so that we can incrementally work up to our year end? What's an example of some of those hard close activities that we could be looking at?
Yeah, asset valuations is probably the biggest area, having that component of the process squared away nice and early. And as I mentioned, that sort of April period is a nice date to aim for. Also look at areas such as your restoration provisions or even employee provisions as well, if they're being kept up to date on a monthly basis and adjusted for, consider what the potential impact in closing off, say, at the end of May would be, 1 month worth of potential movement in that balance, how much of an impact could that have? And realistically, if it's being updated progressively throughout the year, the figures are always kept quite current. And asset additions is probably another area, or WIP capitalisations. Having that close off of WIP, say at the end of May, making sure all the capitalisations are updated to that point. Obviously, there might be some projects that will be material and still ongoing into June and then completed by the end of June. So, there may be potential for some late capitalisations to go through. But if you've sort of looked at the bulk of any processing and transactions, say at the end of May, a lot of the heavy lifting is done by that point.
I guess that would require everyone to be focused on achieving their capital projects towards the front end of your financial year, as opposed to the back end mad scramble to get everything done, so that we're not carrying it forward. So we have another question that's come through. So further to the best practice for the shell statements, we've got, I would recommend earlier than just May. Preparation of hard close in March or April allows you to review and correct issues as they arrive. May is often just too late to fix by the time you investigate. I guess but that would be a controversial statement too. Hard close in March or April, when everyone's doing their budgets for the next year. So, thoughts on that, Tracy?
Yeah, I mean, it's a valid comment, but yeah, I guess it's just finding then the right balance with all of those other competing priorities as well. So I guess the only other thing I'd say to that is, if you've got a robust month-end process where all of your subsidiary modules and balance sheet areas are being reconciled, so you don't have legacy issues sitting in clearing accounts, or some accounts that you don't look at until it gets to that May or June period. If they're kept up to date and you're not having to track back through sort of 10 to 12 months of transaction history in there to get them reconciled and clean, that's another way that avoids any of those surprises, I suppose.
Yeah, that's a really good point. And I think particularly in smaller councils where the juggle is real, that's one way to spread the load across the year, is to build in those month-end processes, in some cases quarterly review processes, not just focused on budgets and capital expenditure, looking at how reconciliations can be done more regularly, so that even if you can't achieve a hard close, you don't, like you said, you don't have those legacy issues. So that's a great point that's come through. So
and even incrementally building on them as well. It's not going from 0 to 100 in the first instance. It's maybe month by month or each quarter you sort of add something extra into that suite of reconciliations. To ultimately achieve, I guess, more coverage over the reconciliations each month end. And yeah, as you say, keep everything clean and tidy. So 30 June really just becomes another month end.
I think that would be the best practice, perfect world to aim for, is so that 30 June is just another month end, another quarter end process for everyone. And the other thing to remember is to use those interim visits from the interim audit visits. Use those to help you identify those issues that you may not have seen because you don't have as much robust, your processes aren't as robust. That still gives, if the interim audits are scheduled in that April, beginning of May period, that should give enough time, if there are some issues that arise, to be able to investigate them before the year end as well.
Definitely.
So the auditors are there to help us through that. May not feel like that sometimes, but they can be our friends.
We're here to help in the main.
Yeah.
We're not bringing out the red pen. It's a very collaborative process.
Do you guys even use green pens anymore?
I do have one floating around. Yeah. I don't like to play into the stereotype too much, though. Whenever you bring it out, you always get a bit of a comment.
Yeah. Look, we've had a fantastic webinar so far. It looks like we may be ending a bit earlier. So last shout out for any questions from our participants out there in webinar world. No. So I guess thank you so much, Tracy, for this fantastic presentation. And I guess before everyone goes, I'd like to thank everyone who attended today. And before we go, we've just got a few messages from the LGFP committee. So a reminder that registration is open now for the Finance Professional Forums. We've got 2 events being held. Friday the 14th of July in Brisbane and Thursday the 20th of July in Cairns. So details on the presenters and how to register is available on our website under the events section. Our next webinar is being held on Thursday the 29th of June at 10 a.m. with Oracle on driving digital transformation in local government, best practice and lessons learned. Registration will open soon. So the next one is marking your diaries for our 2023 annual conference. Our flagship event will be held on the Gold Coast from the 21st to the 24th of November. A copy of this webinar recording will be available on our YouTube channel in the coming days, and the presentation slides will be available to members through the member library. And just one last thing, our latest newsletter has been released, so you can find this in our newsletter archive on our members portal. And if you want to be on the mailing list, please email admin@lgfp.org.au to be added. And you'll find the newsletter arriving in your inbox. There's the June newsletter in particular has a fair bit of important information for end of financial year, timely with this seminar really. So okay, well, thank you very much for your attendance, and we'll be signing off a little bit early. Have a great first day of winter.
Thank you. Thanks, Zoe.
Okay, bye.